Hi, this is Mike Coppell. It's just about 2 o'clock. We have a relatively small group here. If you have questions as we go, just type them in and we'll take care of them as we go. We have a lot to cover in the next 40-45 minutes. If you have questions, please ask them. So let's start. All right, that is my picture. That was my contact area. That's my direct line to the office. That's my cell phone, and that's my office email account. The easiest way to get a hold of me is usually either through cell phone or through email, but I'm usually around if you need anything. Okay. Let me start off with my rules. My first rule is that as presenter, I think it is inappropriate for me to take any type of political positions. Therefore, I will try very hard, even in this incredibly charged economic political time, I will try and stay away from any political positions. If you want to make a political statement in a question, as long as it's not too off the wall, I will answer it and repeat it as we go through. Long ago, or it seems long ago, when I was a young tax nerd, one of my mentors taught me this slide, and that is that we have to remember that what we're dealing with here is businesses. And even though I'm a tax nerd and what I do is taxes, we have to remember that the job of a business is to make money. And therefore, what is important here is that we take a look at every transaction and talk about whether that transaction makes economic sense. And then once we determine that, determine how we can best handle it, which is why I use this slide now pretty much all the time. Don't let the tax tail wag the economic dog. And I think that's a really important thing for all of us to remember. I want to start off with some quotes just to keep everything in perspective. The first is, thanks to Congress for keeping its wayward members off the roads and out of the bars on New Year's. The second is that, if we follow the tax situation like I do, what we would see is that a whole lot of senators and Congress people said, well, this isn't really great legislation, but it's the best we could do at the time. So basically where somebody came along and said, the morning after, as so often happens, there were regrets, which is kind of funny. The last one is actually from a very good friend of mine. And what we have to remember in tax legislation is there's a lot of give and take and negotiation in getting something passed. And what happened in this case, like in most cases, we have earmarks, which are basically a piece of legislation that is added in order to get somebody's vote, so that it is a very, very narrow piece of legislation, usually aimed at just a couple of people or a couple of businesses, or in this case, it was interesting, scan the entire fiscal cliff bill for best tax breaks, algae and economic development, American Samoa, which I thought was kind of interesting considering all of the things that we were trying to get done. One of the things that's really interesting here is what we have to remember is that one of the things that they were trying very hard to do is not to increase middle income taxes. I don't know what middle class is. I leave that for someone else. But what we have to realize is one of the things that was not extended here was the payroll tax holiday, which means that all working people, all people with earned income, would have an increase of 2% of their payroll taxes. So a family of 4 making $70,000 just saw their taxes, their payroll taxes, increased by $1,400, which is, kind of interesting when you talk about what is actually happening to the middle class. One of the things that we have to pay attention to in this discussion is what is considered rich. Now, you may remember, those of you that attended some of our other seminars, that we talked about being rich in Obamacare, as I call it, PPACA, was defined as any married filing joint with AGI, which is adjusted gross income, of $250,000 and single people of $200,000. In this case, we have a second definition of rich, which is a single person with taxable income of $400,000 and a married filing joint of $450,000. Now, if you see my cute little graphic down the bottom, one of the things that's really important here is that what we saw with PPACA, and we see once again here, and we'll see it again in some of our other discussion, is there's a significant marriage penalty that happens here. So that, for example, if you have two successful people, each earning $300,000, they're not going to be subject to the 39.6 tax bracket. However, should they get married, then all of a sudden they will be subject to the 39.6 tax bracket because of the marriage penalty that we see here in the narrow gap between that which is considered for single and that which is considered for married filing joint. The other thing that went up is capital gains and dividends. We also kind of expected this, and there's a couple of things that we have to remember here. The threshold for determining capital gains and dividends is the same as it was for the 39.6 rate. That is what is considered rich. That is when the 20% capital gains and dividends kicks in. The other thing that you have to keep in mind is that PPACA, Obamacare, also added for dividends and most capital gains an additional 3.8% net investment income tax. So that basically what we see is that if you were lucky enough to buy Microsoft or Apple or IBM and wind up with a significant capital gain when you sell it, what you now have is a 23.8% tax instead of a 15% tax. So basically you have almost a 60% increase in capital gains and dividends starting in 2013. Now, one thing I want people to consider, and I underline consider here, and there's been a lot of discussion about this, is whether people should elect out of installment sale. Now, if you sold an asset in 2012 and you only got part of the money in 2012 and you're getting the rest of the money from the sale in future years, you automatically are in what's considered an installment sale. You don't pay tax on the transaction until you actually receive the money. However, that also means that you'll be paying a much higher tax rate when you actually receive the money. So one of the things many people are recommending is that you elect out of the installment sale mechanism. There's a downside here. If all of a sudden when you actually are supposed to collect that money, you do not collect that money, all of a sudden you have what's called a capital loss, all right, because it's a loss on the sale. And what that capital loss does is capital losses can only be used to offset capital gains or be used at $3,000 a year, almost nothing in today's world. So that basically you have to be very sure that you're actually going to collect that money, or you should be not electing out of installment sale. The other thing that's kind of interesting in this situation, and to some degree this applies to the petroleum industry, a lot of people in the petroleum industry not only own their business, but they own the real estate and other structures that go along with it. They own it either in the operating entity or outside the operating entity, which a lot of us recommend. All right? But what you have to realize is that should you sell that real estate, you're going to have a different tax structure because you're going to have recapture of your depreciation. And prior to the new law, basically you had a 25% capital gains rate and a 15% capital gains rate, and a 25% rate on the recapture of depreciation, or a 10% differential. That differential is now down to 5%, being $20,000 to $25,000. All right, so that basically you have to keep in mind what's going to happen here, and a lot of people think that there is going to be a change in the recapture rules in order to reinstate that 10% differential. A lot of people last year, as we were talking about gift and estate, and we'll talk about gift and estate and trusts a little more later, took a lot of assets and decided to do a lot of gifting and put that gifting into all kinds of trusts. what is important to remember is all the things that we're talking about, the 39.6, the net investment income tax from PPACA, and capital gains and dividend rates, all of those things are also effective for estates and trusts at a very low rate. Those kick in at around $11,500 worth of income. So that one of the things that we're talking about, and is going to be very, very important when we get to later in the year, is that we make sure we do what I call trust planning. So we're going to have to sit here and decide who we want to distribute to, or if we want to distribute to, out of the trust to individuals in order to balance, all right, the tax rates between the trusts and the individuals. And this is something that we'll be talking about an awful lot later in the year when we do our year-end tax planning seminars, but it's something that you really have to pay attention to at this time. Every year for the last 10 or 15 years at least, we've always heard that Congress talks about taking the alternative minimum tax exemption and having to raise it for indexing because it was not indexed in the legislation that came in. Now, what is really interesting here is, and I apologize for this, this sounds like a political comment, and I guess it is. You would think that our politicians would have learned a lesson, and when they set up the rates, both in Obamacare and the NII and the 9% for self-employment tax that we'll talk about, as well as for the new 39.6 and capital gains and other things we'll talk about, you think those amounts would be indexed for inflation, that they learned their lesson. But that's not true. Those amounts are not indexed for inflation, and basically we're going to have to see what happens, whether those are going to be indexed for inflation or more and more people are going to be trapped into those higher rates. But what they did here is they made that alternative minimum tax exemption indexed for inflation permanently. So this is something that has been fixed, but they didn't realize that they just set up, once again, just another problem with all of the levels that they've just set up. Now, this is a little technical, but is really important. Non-refundable personal, and you'll notice I've capitalized personal here, credits can be used against AMT. Non-refundable credits are things like the HOPE credit for education, and the child care credit, and dependence credit, and things along that line. All of those things can be used both for regular taxes and alternative minimum taxes. However, what it says is it's only personal credits. That means business credits. Credits, for example, if you should have R&D credits, which I don't think you have a lot of in your industry, but I know that some of you have work opportunity credits. That's hiring for specific classes of employees. All of a sudden, those credits, those business credits, that because a lot of you are pass-through entities, your LLCs or your S-corps, those credits are going to pass through from the business to you. You'll be able to use them in your regular tax. However, they will not be able to be used in your alternative minimum tax. So that basically, if you're in a relatively high state with high taxes, like Massachusetts, like New York, like California, where our son is, if you're in one of those states and you're more likely to be in alternative minimum tax, all of a sudden you may find that some of those credits are not going to be useful to you. And that's one of the other things that as we get close to year-end planning, we're going to have to take a long, hard look at. Now we get to the really bad parts. All right, the first thing is that basically you may remember that up until a few years ago, there was a phase-out of your itemized deductions. That's back. It's slightly different, and let's talk about the way it's going to work. The first thing that has to happen is that it starts off at $300,000, another definition of rich, $300,000 for adjusted gross income, $250,000 for single. All of a sudden, the phase-in starts. Now comes another really interesting situation. The following items are not subject to phase-out: medical expense, investment interest expense, casualty losses, and my favorite thing that is excluded, wagering losses. But think about what that means is subject to your phase-out. That means that your mortgage interest, your state income taxes, if you're in a state that has income taxes, your real estate taxes, all of those things are going to be subject to exclusion, and charitable donations are also going to be subject to exclusion. So that we're going to have to do some real planning in this situation. Now, we can have excluded, you can exclude up to 80% of those items that are not specifically excluded, and the calculation here is it's 3% of the adjusted gross income in excess of the threshold. So let's think about what that says for a second. Let's suppose that you have adjusted gross income of $1 million, married filing joint. That means that basically there's $700,000, the $1 million minus the $300,000, $700,000 subject to phase out at 3%. So $21,000 of your itemized deductions will go away and can't be used. And if you're in a 39% tax bracket, that's like an $8,000 tax increase just because of the phase out of your itemized deductions. Now, one of the things, and we're going to talk about this a lot more towards the end of the year when we start doing year-end tax planning, is something called bunching. So what we're going to do is we're going to sit here and say, if we're going to be subject to phase-outs of our itemized deductions, we're going to want to take a look and minimize how much of those itemized deductions are going to get phased out over the course of several years. So, for example, determining whether or not you make a major charitable contribution to whatever charity you choose, whether you prepay your state, your real estate taxes, prepay your state income taxes, all of those things are going to come into play, and that's something that we're going to have to be looking at when we talk about tax planning for both your business and for yourself at the end of the year. In addition to that, we also talk about losing your personal exemptions. And in this situation, the phase-out starts the same as the itemized deduction phase-out, but it's done in an entirely different way. What happens here is for every $2,500 in excess of the threshold amount of adjusted gross income, you lose 2%. So that basically, if you have another $150,000 in excess of the threshold, you're going to lose just about all of your exemptions. Now, once again, one of the things that we're going to talk about as we do year-end tax planning, and we talk next fall and next winter, is we're going to talk about whether or not there is a way of taking your dependents, taking your children that you'll be claiming as a dependent, and instead of you claiming them as a dependent, in some situations they'll be able to take that dependency exemption for themselves. You would lose the exemption anyway, and it may be beneficial to them, and that's something that we'll be talking about at great length towards the end of the year when we do our year-end tax planning. This is very important for a very select group of people. A lot of businesses today have 401ks for their employees. Now, what this law allows you to do, and please understand this is a revenue raiser, however, for some people this is very, very beneficial. This allows people a second bite of the apple. This would allow someone to actually sit there and say, no, I don't want my 401k to be in a traditional IRA. I want it to be in a Roth IRA. And it will allow you to make the conversion regardless of your age and convert from a traditional IRA to a Roth IRA and pay the tax now. So the question becomes, is it beneficial to be in a Roth IRA instead of a traditional IRA? And that varies very, very much person to person. You really have to sit down with a very, very qualified financial advisor. We are very lucky at Gray, Gray & Gray. We have Dan Romano and his staff that are available that can sit down and help you decide whether or not you should have your retirement savings in a traditional or a Roth environment. It is very much a situation where you have to look at it individual by individual and actually map it out and see exactly what everybody has and doesn't have in their portfolio and what their situation is going to be when they retire. All the education credits and deductions are all extended, as you can see here. No huge deal. All of the individual items are also extended. I want to pay attention to the one on the bottom, and that is because it is something the IRS is paying attention to. So that basically what the IRS is doing, and this is a donation for conservation, and this can be basically you have fields in New Hampshire or Maine or whatever, and you provide a conservation easement. The other thing that happens is a lot of people that are in certain cities are doing easements of their facade of their buildings. The IRS is looking at these extremely closely and is challenging them very, very often. If you are considering at all doing a donation for conservation purposes, please make sure you talk to a very qualified tax advisor as to what the exposure is here before you make that donation. Gift and estate, I want you to take a long look at the person that is shocked, and that is because we were very, very surprised what happened here, and that is that basically we thought the exclusion that somebody is allowed to have for gift and estate and generation skipping, we thought that was going to go down from the $5 million. What actually happened is that this legislation basically kept the $5 million and has indexed it for inflation and made that permanent. That took us by surprise a little bit. It's going to allow a little bit of additional gifting every year, it absolutely took us by surprise. They also kept the concept of portability. What portability says, for example, is let's suppose that the wonderful Tina and I have not made significant gifts to our children, and I'm off cross-country skiing tomorrow, and I get charged and decapitated by a moose up here in New Hampshire. So all of a sudden what's going to happen is I'm now dead. However, what's going to happen is the amount of gift and estate exclusion does not die with me. Basically, it is ported over, it is carried over, and it's going to be available to the wonderful Tina to use in her estate or for her gifting, which is very important. That's allowed. The only bad thing here is that the maximum rate increased from 35 to 40%, which is not too big a deal, and this is made permanent. Now, the other thing that surprises is there are no changes. Discount states, GRAT state, all of those fancy things that estate and gift tax planners do in order to minimize these situations all stayed in place, which also took us by surprise. The last thing I want to talk about is this last bullet, and this is really important. As my understanding, all but 5 states have some form of estate or inheritance tax. So basically what happens is they do not have a gift tax, but they do have an estate and inheritance tax. So if you give away gifts during your lifetime, even if you don't have to because you're below the federal exemption amount, you will be saving state estate tax. So for example, in Massachusetts, the maximum estate tax rate is 16%. So that basically, and it's similar in other states like New York, like California, like Vermont. So that basically what you're talking about here is it can still make sense to make gifts even with this high exclusion amount, just in order to save the state estate tax that would happen in the future. Very good business news. Section 179, the ability to immediately expense items, has been retroactively allowed in 2012 and 2013, and the amount that we were used to, the $500,000 with a phase-out starting at $2 million, is also in place, so that basically everything you can think of is still in place. Now, what we don't know, and basically one of my complaints here is that I hate being in a position where I don't know what's going to happen in the future. In this situation, and again when we talk about bonus depreciation next, notice this doesn't go beyond 2013, so that unless we see something happening later this year in the fall or early winter, we're all going to be in a position where we're going to really have to make a very close thing on timing of our purchases for 179 and bonus depreciation. Bonus depreciation can be allowed at 50%. You have to remember bonus depreciation is only allowed for the purchase of new assets. So that basically if you're in the petroleum industry, which you are, and you're purchasing a new truck, for example, if you are talking about transportation of petroleum products, then basically what you're going to be seeing here is, yes, okay, you're going to be able to transport, you'll be able to take 50% bonus depreciation on the new truck and 179 on the rest of it through 2013. You have to remember, though, if you buy a used truck, it will not be qualified for bonus depreciation, but it will still be qualified under 179. Basically, all the business credits are now back in force retroactively. What's important here, R&D credits probably don't apply to you. Work opportunity credits may apply to you. Energy credits may apply to you depending upon what you're doing. But what you have to remember is most closely held businesses are either an S corporation or an LLC, taxed as a partnership. And what you have to remember here, like we talked about, is that these credits, when they come through to the individual shareholders, individual stakeholders, that it can be used for regular tax, but is not going to be available for alternative minimum tax, which means we have a lot of planning to do if you have significant amount of these business credits flowing through to individuals. I want to talk about a couple other things. The first thing is the net investment income tax. The IRS issued some very long and very complex regulations a couple months ago. Fortunately or unfortunately, I was one of the people that was asked by the AICPA to make comments on those regulations. I will tell you they are extremely complicated. One of the things that specifically I was asked to comment on is that let's suppose that you are doing succession planning and you are going to sell, as opposed to gift, you are going to sell 20% of your business to your child. All right? So basically what you would normally do is you would normally go out and you would get an appraisal done of your entire operation, and you would then go out and based upon that appraisal, you would then go and sell to your children or child. What the new regulations say is you can't have that valuation done based on the entire entity. That valuation now has to be done on an asset by asset situation, which is a real pain in the neck and more expensive to do, I'm told by the valuation people that I speak to. I want to talk very briefly about the earned income 9% tax, 0.9% tax that comes up with regard to S corporations. Basically, any kind of wages that you take in excess of the $250,000 is going to be subject to that 0.9% tax. Anything that comes through on your K-1 is not going to be subject to that tax. However, you have to be very cognizant that the IRS is also very cognizant of this, and they are going to be looking very, very closely at the amount of wages people take out. So, for example, if you have a business that makes $5 million and the stakeholders' wages are only $250,000, the IRS is immediately going to be looking at that and is going to be sitting there saying, why is that reasonable? And it's going to come in and force you to demonstrate that it's reasonable. With regard to LLCs, if you are an LLC, I hope you've spoken to people about bifurcation in order to minimize self-employment tax. It's something that we've been doing a lot of since the year 1999. We've done in excess of 75 of them in the office. I've defended it about 10 times, never lost, never had a problem with it. It is something that can save you a lot of money, and if you're not doing it, you should talk to people. You should talk to us or talk to somebody else about it. The other thing I want to talk to you about Obamacare, and I don't want to get too deeply into the healthcare portion of this because that's a topic all its own, but one of the things you have to recognize is that there are a couple of tests when you talk about numbers of employees. So the first test is, do you have 50 full-time equivalent employees, and we can talk some other time about how you calculate that, and do you have 30 full-time employees? And the question becomes, when do you start counting? And for the 50 full-time equivalent employees, you can start counting either prospectively or retrospectively. And that's a situation where you should really sit down and determine, okay, when should I be doing this? When is it best for me to start doing that? And you really have to sit down and find someone that really understands these regulations in order to determine when it's most effective for you to start counting, especially towards that 50 full-time equivalent employees. I want to talk about the repair regs because they are absolutely going to affect you. They're going to affect you in two ways. The first thing is, like I mentioned, a lot of people in this industry own their own real estate, either in the operating entity or more commonly in another entity. So that the first thing that comes up is the repair regs are a whole new methodology for determining when repairs of real estate, when repairs of roofs, replacement of windows, floors, walls, etc., when those things are going to be depreciable and when they have to be capitalized, and whether or not you can depreciate an entire roof, for example, when it's replaced, which is an entirely new concept in the tax area. That also means that if you did major renovations to real estate in the last couple of 3 years, it is really important that you sit down with somebody and talk about whether or not early adoption of these regulations, which is allowed for 2012 and 2013, whether or not you should be doing that or whether you should wait until they become effective in 2014. The final regulations, we expect them to come out sometime in the second quarter, and when they do come out, we'll get into it in much more detail. This is absolutely going to affect people in this industry. It is going to affect not only your real estate, but you're driving trucks, you're doing maintenance on trucks, you're replacing engines, you're rebuilding engines, you have rotatable tires, you have rotatable spare parts. All of those things are going to be covered by these new regulations, and everything basically that you were doing before is going to be subject to change, and that is something we're going to have to look at very closely when the final regulations come out. The IRS and the Department of Labor have clearly indicated that one of their major thrusts in enforcement is going to be in worker classification. Worker classification is a worker an employee or are they an independent contractor? As an independent contractor, you don't have to pay any benefits for them, no health care, no workman's comp, no unemployment compensation. You don't have to withhold on them, et cetera, et cetera, et cetera. As an employee, obviously, they have to do all of those things. IRS and DOL are going to be looking at that extremely closely. They've already said that. Now, how you make that determination is not a bright line test. It is something that goes on an item-by-item basis. And I want to tell you a very quick story, just because I found it a little bit humorous. There was a strip club, an exotic dance club, or whatever you want to call it, in the Midwest, and the exotic dancers were considered to be independent contractors. Fortunately or unfortunately, the strip club closed, and the dancers went to go and collect unemployment insurance. And they were told they couldn't collect unemployment insurance because they were not employees of the dance club. And basically, they took this to court, and basically they said because the strippers were told when they could go on and basically told what they could and could not do with regard to the customers of the club, that they were employees and not independent contractors, and therefore were entitled to get unemployment insurance. And it didn't stop there, because they then went after the business, which was defunct, and they went after the responsible people, anybody who had the ability to decide who would get paid or to sign checks, they went after them for the unpaid taxes that the strippers didn't pay. So that's kind of interesting and, you know, kind of funny story, but that shows how aggressive they are. Now, the IRS and the DOL currently have a limited amnesty program, which expires the end of June. If you think you have any issues in this area, please find an employment attorney or give me a call and let's talk about it. The possible penalties here are severe and can go both to the business as well as to the stakeholders and key employees. So that's something we really, really want to talk about. We know more is coming. We have the debt ceiling and the sequestration. Sequestration is coming up in the next couple of weeks at the beginning of March. Debt ceiling comes up the end of March. We don't know what's going to happen here. There's a lot of discussion that there may be more revenue raisers that come up, especially from the sequestration situation. The sequestration is going to take a significant bite out of a lot of government agencies. For example, you know, don't cheer too loud, but the IRS announced the other day that if something isn't done about sequestration, they're going to have to put some of their employees on furlough, which is kind of interesting to notice. So that is something we're going to be keeping track of over the next few weeks and months. You heard me say that some of the things that we talked about out there were permanent. I've been doing this for a lot of years, and one of the things that I've learned is that in the tax arena, the definition of permanent is until Congress changes it. So don't go on the assumption that everything we said is permanent is going to be so. The tax realm is changing rapidly every day. You know, it takes me an hour and a half every day to keep up with what's going on in the tax world. So that basically that's where we're at. I've kind of rushed through this. It's a relatively small group. Does anybody have any questions that they want to ask? I know a lot of people, for whatever reason, I have learned that people don't ask questions as often in webinars as they do when we're actually sitting in a room. So that basically, if you don't want to ask it here and type it up, give me a call, send me an email. I have a bunch of them for the last couple of days. I'll be answering all of them probably tonight or tomorrow. If there's anything else you want, please give me a call. There's our disclaimer. There's all of our social media that you can do. If there are no questions, then I want to thank you for attending. And once again, should you have any questions or if there's anything else you want to talk about in this arena, please feel free to give me a call or send me an email. Thank you.